Hi everyone, welcome back. Now in this lecture, let us focus on Unit 3 of Financial Instruments, which is distinguishing equity and financial liabilities. Alright, we're going to discuss the topic equity and financial liabilities. Let's look at illustration number 1. A Limited, which is the issuer, issues preference shares to B Limited, which is the holder. Those preference shares are redeemable at the end of 10 years. All right, they're redeemable at the end of 10 years from the date of issue. And these preference shares also entitle the holder to a cumulative dividend of 15% per annum. Now remember, preference shares have got two characteristics fundamentally. One is redemption, the other is with regards to dividend. In this question, the question has mentioned that these preference shares are actually redeemable at the end of 10 years from the date of issue. So if A Limited has issued these shares today, they have to be redeemed, which means A Limited will have to give cash to B Limited at the end of 10th year. All right, 10 years after today, A Limited will actually have to give cash to B Limited. Now, the second characteristics with regards to these preference shares is dividend. The question has mentioned that the dividend percentage is 15% per annum and the nature is cumulative dividend. What does that mean? Basically, if A Limited does not pay dividend in this year, if A Limited does not pay dividend in the current year, it will have to pay the dividend for the current year also in the next year. All right. So next year, it will have to pay dividend for the previous year and for the current year. All right. So whenever A Limited skips payment of dividend in one particular year, it will actually have to pay the dividend in the subsequent year. That is the meaning of cumulative dividend. The other type of dividend can be non-cumulative, where if A Limited does not pay dividend in the current year, it is not obligated to pay the current year dividend in the next year. All right. If I skip paying dividend in the current year, I would need not pay the dividend for the current year in this next year. That is an example of non-cumulative nature. Over here, the question has mentioned that the dividend is actually cumulative and the rate of dividend is 15% per annum. The rate of dividend is commensurate with the credit risk profile of the issuer. All right, this is not really a relevant sentence as of now. We'll actually see as we go further into the illustrations, we'll see the implication of this sentence. All right, for now, it does not really hold great relevance. The question is examine the nature of financial instrument. We have to examine whether from an A limited's perspective, all right, from A limited's perspective, which is from the issuer's perspective, the person, the entity which has issued this financial instrument, is it actually equity or is it a liability? Examine the nature of financial instrument. It's basically from the viewpoint of the issuer. Now, remember, one of the characteristics that distinguishes equity and liability is liability. In a liability, you basically have an obligation to deliver cash. All right. If you have an obligation to deliver cash, that will be regarded as a liability. If you do not have any obligation to deliver cash, it will be regarded as equity. All right. If you think of normal equity share capital also, in case of equity shares that an entity issues, entity does not have an obligation to pay dividend. All right, remember, an entity usually has a discretion with regard to payment of dividend, and same way the entity is not required to repay the principal amount, repay the face value. All right, that is also at the discretion of the entity. The entity can choose to do a buyback whenever it wants to. Otherwise, equity shareholders usually receive money only at the time of liquidation. All right, so for equity shares, typically we do not have an obligation to pay cash. Whereas for something to be classified as a liability, you will always have an obligation to pay cash. The question in this case is whether these preference shares that A Limited has issued, is it actually a liability or is it in the nature of equity? All right, when I'm using the word equity, what I'm basically referring to is I'm referring to shareholders' funds. All right, so when I actually issue these preference shares, I am basically going to receive money. All right, so I will debit bank. All right, we are going to basically debit bank. Now the question is, what will we credit? Will we credit liability account or will we credit shareholders funds? The question is, what will the credit go to? Now for that, we have to basically look at the characteristic of the instrument. All right, we have to basically look at the characteristic of the instrument. If you look at it over here, with regards to these preference shares, I mentioned that there are two characteristics. One is with regards to redemption, the other is with regards to dividend. All right, in this case, The preference shares have got a stated maturity of 10 years. All right, the preference shares have got a stated maturity of 10 years, which basically means the entity has an obligation to pay cash back to the preference shareholders. Entity has got an obligation to pay cash back to B Limited at the end of 10th year. All right, so does the entity actually have an obligation to pay cash with regards to the principal amount or the face value? The answer is yes. The entity is obligated to repay the face value. Whatever money it's receiving today, it has an obligation to repay that face value at the end of 10th year. The second characteristic is with regards to dividend. Does an entity have an obligation to pay cash with regards to dividend? The answer over here is also yes, because the entity cannot avoid making the payment of dividend. If the entity does not pay dividend in the current year, it is obligated to pay dividend for the current year also in the next year. All right. For example, let us say the first year is FY 24-25. All right. If the first year is FY 24-25, and if the company, if A Limited skips making the payment of dividend for FY 24-25 in 25-26, in the next financial year, it has to pay dividends for 2 years. It has to pay dividends for FY 24-25 and for FY 25-26. So can the entity skip the payment of dividend of 15%? The answer is no. Entity is obligated to make a payment of 15% for every year. If it skips in 1 year, it is obligated to pay in the next year. Reason being, these are cumulative in nature. Because these are cumulative in nature, the entity basically is going to have an obligation to pay cash. If not in the current year, it will have an obligation to pay it in the next year. All right. So with regards to redemption, the entity has an obligation to deliver cash at the end of 10 years. With regards to dividend also, the entity has an obligation to pay cash every year of 15% per annum. If it skips making the payment in the first year, it cannot avoid the payment for FY 24-25. It will have to make the payment for 24-25 also in the next financial year. All right. So analyzing these two characteristics, the entity actually has an obligation to pay cash to B Limited. A Limited has an obligation to pay cash to B Limited, and therefore these preference shares will be classified as a liability. These preference shares will be classified as a liability. So the journal entry will be bank account debit to financial liability. Whatever money that you're receiving, you are basically going to credit it to a financial liability. As per Companies Act, preference shares might probably be regarded as share capital. That does not matter. All right. Although, as per Companies Act, preference shares is regarded as share capital, you cannot show these preference shares as part of equity or shareholders' funds. You cannot show these preference shares as part of shareholders' funds. This will be classified as a financial liability only. All right. Further, the dividend of 15% will actually be recorded as interest expense every year. All right. We are going to regard these preference shares as good as debt instrument. We're going to regard this as good as a debt instrument, and the 15% dividend that we are paying will be regarded as interest expense, which will be debited to the P&L account. All right. So this 15% will basically be debited to the P&L account. That is with regards to illustration number 1.